Hello, everyone. Thank you very much for joining today's webinar. My name's Nick Sean-Ambus, and I'm just going to spend the next kind of 25 minutes or so just talking about how to help people who are in the kind of pharma and medical device industry, basically to plan more effectively. There's going to be a few takeaways, and I do appreciate the fact it's a busy time of year. And I don't take that for granted. So thank you very much again for attending. For those of you that listen to this on playback, this webinar, which is being done on the 23rd of November, really relevant to really the end of 2023, but does, I suppose, give a lot of, hopefully takeaways from today that will enable you to become more financially, savvy and successful going forward. For those of you that haven't had any dealings with Alpha Wealth today, I'm, managing director for 10 years now. We set up the company about 10 years ago. I've been a financial advisor for over 25 years, and I have a lot of experience with a team of about 10 who are based in Cork and Dublin, giving independent guidance. I'd like to try and make this session as interactive as possible, and I am joined by one of my colleagues, Ruth, who's our head of marketing, who's going to just basically manage the questions. And if anyone does have any questions, please do feel free to put them in to the Q&A. I just want to make sure that we are covering areas, obviously, that are important to yourselves. We have received a few over the course of the last couple of weeks, which I think Ruth will pick up on. Just in terms of the team, I won't dwell too much on this, but Clean O'Donoghue, who is our Director of Business Development, has about 25 years in a pharma industry, having worked for AstraZeneca and Boehringer Ingelheim. And it's interesting because I suppose she would have been on that side of the fence, particularly in relation to this time of year, dealing with like bonuses, trying to reduce the tax that you pay, and making sure that you do the best with your money. So today's webinar, the main focus really is how can we help you reduce the tax you pay? I want to kind of spend a little bit of time basically talking about achieving your short, medium, and long-term financial goals, which I think is something that all of us should do at least on a once a year basis. And then finally, there's a big movement towards retiring early. I don't know if you've heard of this phrase called FIRE. It's financial independence, retire early, where people are making sacrifices. I think it's probably a little bit extreme, to be brutally honest, but the notion of being in a position as quickly as you can to choose whether or not you want to work, particularly in the same environment, is something that I think we should all strive to do.
Nick, sorry to interrupt you there, but can you just give a quick sense of how someone can reduce the tax they pay?
Yeah, thanks, Ruth. So just in terms of reducing tax, and I know it's not a particularly kind of interesting topic, but tax is the biggest cost that we bear during our lifetimes. And for most of us, particularly for everyone who's working in the pharma medical device industry, you're POE workers in the main. You obviously are paid typically over the standard rate threshold, which next year from January will be 42,000 a year. And everything you earn above that, you're taxed at about 51% of that. You've only really got two simple ways to reduce tax. I know I said five there, and there are five ways that you can reduce your tax. The two main ones tend to be pension contribution, which is with your own company pension scheme, and the second is a scheme that I'm going to give you some information of in a moment, called the Employment Investment Incentive Scheme. And this scheme is available to everybody in Ireland who's paying tax at the higher rate, where you can get 40% back of a contribution you make into one of these qualifying companies. I'm going to explain this to you, but this is a really simple tool to use, as is your pension scheme. And again, I'll go through that. Really, the starting point for most of us, and again, I mentioned this earlier, is set out your financial roadmap. Think to yourself, like, what is really important for you now? What are you trying to achieve financially? Is it that you want to try and reduce debt? Are you looking to try and buy a property or move up the property ladder? Are you looking to try and fund your children's education? Is it a combination of all of those things? And where I think a financial planner comes into play is that they can help you find the right balance. That tends to be most of what I do for clients that we engage with. And it is really important to check in with somebody. So even if you've had a financial review a few years ago, so many things change from a point of view of, obviously changing jobs, getting pay rises, getting bonuses, people who are in a relationship where their partner may, not be working. You may have had a child, you may have got divorced. These all warrant having a check and seeing where you are. This slide, hopefully, that you can see on the screen there, and I call it the secret to financial success. It's such a powerful tool, and I would encourage all of you to consider using this. You can access this through a lot of the online free tools that are available. We have it available on our Alpha Wealth website alongside a lot of webinars that we've done over the last while. My colleague Ruth has just put into the chat the link for you to access this. And it really is powerful, guys. And what I would do is I'd encourage you all to consider filling this in. If it's over Christmas, that's fine. We tend to do this kind of like turbocharge your January when we all tend to feel a bit guilty about what we spend over Christmas. And interestingly, I was just doing something for the Sunday Times in relation to kind of top tips over Christmas, which I will share with you in a follow-up, and I will send on details of today's webinar, including the video, for anyone who misses any part of it or wants to listen again, but also the financial budgeter and the top tips. I mentioned earlier about paying back debt. A lot of us turn to debt at this time of year, whether it's to use a credit card or take out a personal loan. And whilst I'm not dead against taking out debt, there's a couple of things I would say to you. One is that you need to be cognizant of the fact that, you need to pay back this interest. And unfortunately, interest rates have gone up, as we're all aware. The second thing is that it is a case that make sure that you budget for this in relation to paying back this loan a lot quicker than the bank would like you to. It will prove to be much more beneficial to you. And again, I can show you I suppose, ways in which we help our clients to deal with this, whether it's existing or new debt that you bear. Okay, so a menu board. What is this? One of the key takeaways today, guys, is that if you think about what you earn and what you bring into the household, and that may include your partner, it may include rental income, it may include the child allowance for however many children you have. Think about what you have to spend and how you're going to allocate that. And normally using that financial budgeter allows you to know what monies are available. And I use a phrase, I call it save first, spend later, where a lot of us strive to try and put money into savings accounts, but for whatever reason, it doesn't always work out because we have a life event that happens, or we get invited out a lot more and spend more money than we anticipate. We can't keep saying no to people, so we tend to dip into our savings. And again, whilst I want my clients to live the lives that they want and feel that they deserve, if you can start by saying, well, I'm dedicating putting 5% of my salary into my pension, you shouldn't really deviate from that, because what's left over is then left for you to spend. Same thing then in relation to savings. People often ask me, like, how much should I be saving? And I say to them that generally 10% of your salary is the guide that I would use. And whether that's broken up into short term, whether you have any plans to spend the money again on a new car, looking for a deposit for a house, or whatever it might be, that typically would be the starting point. With respect then to longer term arrangements, and I'm going to lead on to compartmentalizing your financial goals. This is broken up between short, medium, and long-term savings. And again, I talk about, this dashboard where you can dial up and dial down depending on what your goals and priorities are. Moving on to long-term savings, and I'm not going to spend too long on this, but I mentioned at the start of this, one of the best ways to reduce tax is to pay money into your pension scheme. And a lot of you are offered a pension through your employer. And what I've put up on the screen here is just an example of where you should try and aim for. Because a lot of us don't even know what we have in our pensions, don't mind what we're looking to try and achieve. And I talk about a sweet spot. So as a couple, or if you're on your own, I would suggest that you should try and aim for a projection, either at 60, ideally, depending on your age, it might be a bit later, it might be even earlier that you're looking to try and reach that financial independence, that you should be looking to achieve a pension fund of somewhere between 6 and 800,000. And you might say, well, why those figures? Take the example of 600,000. If you happen to reach age 60 and you've got 600,000 euros in a pension, it's not specifically just a pension, but I'm going to use pension for the purposes of this. It could be rental income that you receive as well. You'll be entitled to take a quarter of that tax free, which is 150,000 euros, leaving the remainder, which will give you an income of approximately about 22,500. It's a very conservative rate that I'm using here. When you get the state pension, which currently is payable to you from age 66, that brings you up to just around the threshold rate of somewhere between 40 or what's going to be 42,000 from January of 2024. In my opinion, that would be enough for most of us to live reasonably comfortably in our twilight years. You might want to work, you may want to work part-time or do something different, but certainly that would be a really good basis. So
Uh, sorry to interrupt you there. Someone just wrote in to say, what if they don't know what their pension is worth currently?
This tends to be the thing that whenever we come across people, and thanks for the question, and please do feel free to pop any questions into the Q&A, guys. We can assess for you very easily. So it's a case of we just ask one thing of people that we engage with is to give us the authority to get details on any arrangements they have, including any current and indeed previous pension schemes. And the opportunity of doing that is not only to show you your projection, because it's very difficult to do that without that figure, even if it's just a generalized, rough amount. But also, let's say, for example, you worked in AstraZeneca and you went to go and work in Lilly, and you had 5 years of, I suppose, pensionable employment with AstraZeneca. A lot of people wouldn't know where that pension is, what it's doing, how they're going to access it, and so on. And by dealing with financial advisor, preferably Alpha Wealth or whoever it is that you currently use, you should really get a sense of what that pension is worth, where it's invested, is it in the right vehicle for you? Knowing that you can access that from the age of 50, which could be very helpful for you to pay down debt or to help you fund things like children's education needs, and understanding the pros and cons of doing so. For a lot of us, though, it certainly is an opportunity that we often pass by just because we didn't realize that these are investment schemes and need to be managed. This graphic here shows you my own independence roadmap. So I've just turned 50. I did this a few weeks ago. And it just gives you a sense of the way in which we help people. So people say to me, Nick, oh, I've heard this all before. Pensions are just a way of tax deferral and so on. And I say, absolutely not. Pensions are savings plans on speed. They really are. And the reason I say that is because not only by joining your company pension scheme, will you get a free payment for your company. Now, I'm assuming a contribution rate here of 500 euros that the company would pay in on a matching basis. Now, obviously, this is dictated by what salary you're on, but just for the purposes of this illustration. And if you join the company pension and you're forced to pay in 500 euros, your company will match that. Therefore, you're going to get 500 euros invested for you for free. Secondly, the government will give you back 40% of your contribution. So your 500 euros only cost you 300 euros. And this is at source. You don't have to do anything to get that 200 euros back. It's done automatically for you. But for a cost of 300, you now have 1,000 euros being contributed into your pension scheme. The other advantage of the pension is that for me personally, just turned 50 and having a financial roadmap to age 63, I've got 13 years of growth of the money I've accumulated and any future money that will grow tax-free. And I'm looking to achieve a fund growth of about 6% per annum, which is shown on this graphic. Finally, you get 25% of your fund tax-free from the age of 50 onwards, depending on what would be realistic for you. And all of those advantages are enormous. They really are. You can see midway on this chart here that my current projection is aiming for about 770,000, which in today's money is about €500,000. And that would satisfy what I mentioned earlier, that 6 to 800,000 kind of fund, probably on the slightly higher end, based on the contributions. But again, it's whatever works for you, and it's doing the best that you can in the position that you're in. With respect to short-term savings, the one thing I'm going to say today is that don't accept no interest anymore from the banks. We had to for the best part of 10 years while interest rates were next to zero. The mortgage holders that are being crucified at the moment because of the hike in interest rates, the savers, people that have money in the bank or credit union, you can take advantage of that. You should be getting at least 3% a year from your monthly savings, and you should be getting at least 2.5% a year from your lump sum deposits in the bank. You can do even better again if you look at some of the German online banks like Trade Republic and Raisin, who are paying up to 4.25%. And if anyone wants more information on that, please do contact me. But as I say, there's a really simple kind of solution to people who have money in the bank that's doing nothing for them. And the general rule of thumb, by the way, that I use is that if you're working in a pharma company and you're obviously, being paid monthly, you don't need a large amount sitting in the bank earning even as much as 3%. I would suggest that you keep that down to what you feel comfortable with. Generally, probably 2 months of your net earnings, don't mind gross, and that's as much as I would recommend. So obviously, if you're on 50,000 a year, probably netting somewhere around 3.5. I would suggest that no more than 7,000 should be in any of those institutions, the bank, credit union, post office, for any period longer than 12 months, because I think there are better solutions. This leads me on then to medium-term savings. And this is where we help people in terms of this roadmap, as I referred earlier to, which is that you can save money, get growth of somewhere between 4 and 6% a year. I'm using a conservative rate of 3.5%. And if you're looking to build 30,000 up over the next 4 years, simple math based on that interest rate would mean that you need to put in about 570 per month. If you happen to have a lump sum, again, growing at that 3.54% level, that would require you to put in €400 a month. However, if you don't earn interest on your money, you have to put as much as €625 a month instead of the 570. There's a massive variation over even that short period of 4 years. This chart here on the screen is one of the biggest takeaways from today. I would really encourage all of you to understand it. What it is showing you that whatever money you have, whether it's in a pension, whether it's in a savings account, you should think about this chart and say to yourself, okay, how long do I have until I'm going to need that money? If it's within 24 to 36 months, you need to stay around the numbers 1 and 2. And this is simply investing by numbers. And you might think, well, what does that mean exactly? Well, as you can probably take from the chart, it gives you a low level of return, but a low level of risk. However, if let's say you've got 5 to 10 years before you're going to need access to these monies, let's say you're saving for a house 5 years from now, you don't, and you shouldn't accept those sorts of returns, because inflation, which is currently around 4.5% at the moment, probably will tend down to about 3%. You're going to lose money every year unless you're getting that return. And by you putting money into alternative accounts over that medium term period, can you try and achieve that? For those of you that are in your 30s and 40s who are looking to put money into your pension scheme, you should be higher up on the scale again. And this is where we, as an independent broker, can help you in making sure that you're in the right fund for you in terms of what works. One of the best savings accounts available in Ireland is through one of the providers called Zurich. We operate, as I mentioned, independently. We show you how these accounts work. We provide them at the lowest fee. It is something I encourage all parents to consider, particularly for the child allowance. It's a really great vehicle to build money up for your kids. It offers you complete access to the monies. You can turn it on, off, or down like a tap. You can access the funds whenever you wish to. It grows at a rate of roughly, as you can see on the screen there, towards the bottom right-hand corner, over a 3 to 5 year period, around 4.7% a year consistently is what it's returned. It can earn more, it can earn less, but typically that's the sort of growth rates that we would experience. And it's certainly going to give you a much better return on your money than you would experience if you left it in the bank. This graphic here, I suppose I'm showing how to beat the bank. What if you have a lump sum of money? And what if you don't need it for 3 years? You can see here that with some of the insurance companies, in this case, Aviva, they'll offer you 11.4% guaranteed, risk-free, if you leave money with them for 3 years. There's no variation of that. Doesn't go up or down. That's a much better return than you'll get if you leave it in any of the Irish banking institutions. And again, I'm back to what I said earlier. Don't accept low rates. There are reasonable returns to be had, but you need to talk to somebody, an independent broker, preferably, who can help you explore these.
Sorry, Nick, just one quick question. Is this the best account to invest in?
It's one of them. And whilst you might say, well, okay, what's better than this? One of the things I always say to people is you need to have different types of investments for different things that you may require. So obviously this account works really well for anyone who is quite conservative and wants a fixed return on their money. But when you analyze it on a yearly basis, and obviously tax must come off those figures, and it's important to understand that tax will always be taken from any accounts that you have, you're really just about keeping pace with inflation, which I'm assuming at 3% a year. However, there are other options, like the account that I just mentioned here with Zurich, where you can earn a high rate of interest, and it might well be a blended approach that would be sensible. So you've kind of got the best of both worlds. Now, I'd even go a step further and say that for those of you that are high rate taxpayers, where you're paying 40% back, sorry, some of the graphics is cut off here, but you can basically avail of a scheme. It's called the Employment Investment Incentive Scheme. And there are two companies that I would strongly recommend that you can put some of your bonus monies that you may have sitting in the bank that's not earning much for you, as long as you can afford to leave it there for 4 to 5 years. The scheme, which we can send you more information on, you can Google it. It's government approved. As I said, it's called the EIIS scheme. The two companies that I just wanted to touch on today, and I'm not going to go into detail, but as I say, today being the 23rd of November, you've got about until the 7th of December, which is about 2 weeks' time, to decide whether you're interested and available in this opportunity. Now, we give advice to people. We explain the scheme to them, how it operates, the risks involved. As most of you can probably tell, that there is risk with this. And the risk is basically that you are giving money to an Irish company, which is essentially a share in that business that you're being offered. You do have a legal agreement that sits beside that. The company has to remain solvent for those 4 years. Otherwise, you're not going to get your money back. Now, of course, you would expect a professional advisor like Alpha Wealth to have done due diligence. Of the 70 or so companies each year that look for this type of finance, these are the two best. 5 Mile, for example, is a restaurant and rotisserie in Cork, in Middleton. It may sound a little bit left field to some of you, but 5 Mile was acquired by a fantastic group called Clistra, who own a number of hotels and restaurants up and down the country. They own the Radisson in Little Island, very close to where I'm sitting currently. And the group have bought this property. They're going to renovate it into a state-of-the-art, as I said, restaurant and rotisserie. This video, which I'd like to show you, which hopefully I can get working, will give an example of how this operates. And I'd like you just to listen to this.
Are you looking to make a smart investment move and significantly reduce your tax bill this year? 5 Mile Concepts presents an opportunity you don't want to miss that aligns perfectly with the booming out-of-home food sector. Now, through the Employment Investment Incentive Scheme, you can be part of this growth. Imagine being part of this new venture, a state-of-the-art roastery and cafe based in Middleton, Cork. This space isn't just a cafe, it's a hub for barista training and a dedicated coffee lab for the renowned 5 Mile Coffee. The restaurant plans include seating for 110 guests and an external area for events. This is your last chance to get 40% tax back on your investment in 5 Mile. Be part of a brand that's already a favourite in hotels nationwide and is set to make a significant mark in the out-of-home food sector. Don't wait. Contact us today at Alpha Wealth to learn more about this limited time investment opportunity.
There's been quite a bit of advertising around this as well, and as I said, we can provide you more information, including the prospectus, and really kind of give you further information around why the scheme might work favourably. The minimum investment, by the way, into the EAS scheme, I should have said, is €5,000. So if anyone is paying tax at the high rate, or indeed if it includes your partner, you can avail of this scheme. The second company is called Blacks of Kinsale. They're a whiskey and beer company who have just finished the distillery that's on the screen there. It's a fantastic site. We have another video on that as well. I won't share it with you today, but again, we can provide information around the opportunities both in 5 Mile and in Blacks. And it gives you the ability not just to get 40% back from the government. So if you, for example, put in 10,000, the Irish government will give you back €4,000. That's a 10% return each year for those 4 years, and it's given to you straight away. But on top of that, you expect interest back of somewhere in the region of 28% over the 4-year period, which is a further 7% a year. With that risk that I spoke about, but these are two companies that I believe firmly will grow over the next 4 years, not just stay still. I think it's definitely something to consider, particularly if you are availing of a bonus or have money in the bank. And given where interest rates are, I think this will be a fantastic option for some portion of your funds, and to work as a complement to your pension scheme. Pensions tend to be longer, obviously, for most of us. The beauty of the EAS scheme is that it's a 4.5 year scheme. And this, by the way, is the last year where you are guaranteed to get 40% back from all companies. And that's why I'm really keen to try and make sure that people are aware of this.
Sorry, Nick, just one quick question there. Someone just asked, how do you go about investing one of these schemes?
It's really easy. So the process is that, again, we package the application process for you. It's all done via DocuSign. It's a very simple process. We just require some identification, and the payment of the funds are really what get you in. So what I say to people is, if you have an interest, reach out to us. We can send you information on both companies. Really, the way to go forward, though, is that we send you the application form and you transfer the funds. The fees, by the way, and it might surprise you, but there is a once-off fee of just 2%. So if you put in €10,000, Alpha Wealth will manage that money for you. We put the investment together, all the application process, and the only charge is €200 on 10,000. We could charge more. We certainly make more money on other investment options, but this is one that I would like to at least make people aware of, alongside whatever else that they are saving for and obviously planning towards. The last thing I just wanted to touch on today was managing your tax credits. I said earlier about the 5 ways to save tax. I've spoken about pensions. I've spoken about EAS. Managing your tax credits probably counters for about 10 more, which is claim for things that you're entitled to. Michael McGrath said in the budget last month that about 50% of us don't claim for the things that we should be. What should you be claiming back for? Well, things like if you're renting, the rental tax credit that we're all now hopefully familiar with, but many of us haven't claimed for, where you can basically claim back for up to €1,000 last year and this year on your own, and that's doubled, obviously, if you're in a relationship. If you worked at home during the COVID years, which I think probably applies to most of you, if not all of you, you can claim back for certain energy expenses that you suffered, but yet many of us haven't done that. The way to do this is through the Revenue Online System, or ROS. And it's really, really simple, guys. And again, in my email, I'm going to send on to you, you'll get the step-by-step way to access the ROS system and how to go about claiming back for credits. And you can go back up to 4 years. And it's money there that's sitting waiting for you to take back. I would encourage all of you to consider this. The final thing then, just in terms of summary, is that we give guidance and advice to people in relation to mortgages. I don't provide mortgages, but certainly can help you independently make sure that you pay the least amount possible. For most of us, it's simply a phone call to your existing provider to make sure that you're on the best rate possible. And if you're coming off a fixed rate shortly, or if you're on a tracker mortgage, I strongly would encourage you to contact your bank and get the best fixed rate you can for the next 3 to 4 years, whilst interest rates are likely to remain quite high. If you would like to then share that information with us, we're happy to give you guidance around whether it would make sense for you to refix now or not. Certain insurances, we all pay too much for insurance costs, mostly because we're time poor and mostly because we're probably not aware of the fact that a lot of the time we can bargain discounts, particularly in relation to things like house insurance, car and health insurance. And I'm something that I can certainly assist you with going forward without any drama whatsoever. Pensions, I know it may seem strange to say, well, how can you save me money on pensions? A lot of you who may have pension schemes from previous employments are paying way too much in charges. And there's an easy way to reduce the cost that you are paying that you probably don't even realize. Same for savings accounts. Some of you may have already set up savings accounts with various different financial institutions. And it's not until you look under the bonnet of them and see the fine print do you realize what the fees are. What we offer you is basically an independent review process where we get information for you, we set out the roadmap, we can help assess exactly where you are and basically set out the direction that we feel that you're going in, and do that on an annual basis. And there's a once-off fee that we charge of 99 euros. It's normally 199, but the discount code that I've put on the screen there, Alpha 50, which you can book online. My colleague Ruth might kindly put up into the chat just the link to book an appointment. And that's a review with David Looney or myself, where we go through basically an assessment of where you have, and there's no drama with it. Somebody didn't want to book an appointment with me last week because they thought it was going to be a load of hassle. And I said to them, if they could just answer 10 simple questions, that's all we typically require. With respect to going forward, the last thing just wanted to mention is that we are doing continued webinars. I mentioned that you can access some of the webinars we've already done this year, which relate to savings. There's one specifically in relation to reducing tax, also how to get the best out of your pension. But the next one is on the 12th of January. It's on a Friday, 1 p.m. And essentially it allows you to benefit from a lot of these tips that I've kind of touched on today, and just drilling a little bit deeper in terms of setting out, I suppose, supercharging your finances for 2024 would be another way of describing it. That was everything that I wanted to cover off. My email address, which is really easy, and if anyone has any questions that they want to ask after this, or if you listen to this on video, just feel free to pop me an email. There's no cost to doing that. However trivial the question is, I got asked a question about inheritance and gift tax the other day. More than happy to provide information to all individuals around any aspect of personal finance. Do follow us on social media. You can obviously follow us on Instagram. Do check us out in terms of any other information that you might require. And also, we are looking for feedback, and certainly I'd be interested to know, if there is any topic that anyone would like to, and if it's okay with you, on the email that I send out later on, I might just ask you to complete a survey. It's a very short thing. It takes about 30 seconds in respect of not only today's webinar, but also future webinars that we may do. If anyone would like to ask any questions, please feel free to do so in the Q&A part. Ruth, I'm not sure if there were any questions that were asked that we haven't covered off.
Just two quick questions. So the first question that we got in was, is now the time to de-risk my pension?
That's a question that actually comes up quite often, and I suppose in short, no. The key thing is not to get bogged down by the noise and news that you hear. So a lot of us get concerned when we read the news, and it's particularly in relation to things like Gaza and obviously Ukraine. And the fact of the matter is that markets price this news in instantaneously. So there's no point worrying about something that you may or may not understand is going on. The most important thing when it comes to risk is about time, as I mentioned earlier. So the short answer to the question is typically no, but get professional advice. I would suggest to anyone who's concerned about the value of their savings or their pension, just reach out to us and we can give you that guidance very simply.
And sorry, the other question was, what other financial tips can you give?
Log on to the webinar on the 12th of January. And, joking aside, honestly, there is going to be a lot more takeaways that we're going to give people. So it would be probably the best way to kickstart the new year. The main things I really wanted to get across today are that you can still reduce tax before the year end. The EAAS opportunity certainly is one of them. Reviewing your pension and considering paying more money into your pension, perhaps from January, because we're all going to earn more money next year because of the changes in the budget. On average, about 2,000 a year better off. Think about how you're going to use that money. Think about, can you put a little bit more to your pension? Can you put a bit more to savings before you get used to getting that money into your account? Because by the time you get it in, you will typically find that you're going to spend it. Now, again, it's very holistic for me to say that, but this is why having a financial review, I think, is kind of critical. And it would be important, regardless of who you deal with, whether it's the bank or an insurance broker, whoever it is. Sometimes getting independent advice is no harm. Again, it's always good to get someone with a fresh pair of eyes to review your present situation. So thank you very much again for your time. I'm just conscious of time today, and I do really appreciate the time that you've taken. For anyone who's listening either live or on playback, if you are interested in more information on anything I've covered today, please do email me, nick@alphawealth.ie. As I mentioned, will get me, and we look forward to maybe talking to you in the near future. And indeed, hopefully, if you can sign up for the webinar in January. Thanks very much again, guys, and I do appreciate your time. Enjoy the rest of the day.